San Diego, what's good? It's May 25.
Yeah.
You got your market update, and you know that you come here not just to talk about some stats and some data. Sure, we got that, and we got that.
Is it for the entertainment?
But it's for what Jeremy's wearing under the table that you can't see in the camera. It's for taking the data and telling you what it is that you need to know about the data so you can make an informed decision, either buying, selling, or borrowing. As we move now, this is the spring, summer market, man. This is when all the magic happens.
Yeah, and data is the thing that is changing constantly right now. Speaking of data, one of the biggest data points I think anybody watches is interest rates, right? It drives the entire market. Buyers are constantly interested in it. Sellers are interested in it. So what are we seeing right now? Well, normally what you see is a directional pairing of the stock market and interest rates, right? So as the market continues to go up, we'll often see interest rates will go up. Market goes down, we'll see interest rates go down. And so in some ways you think, hey, these big market crashes, this is perfect, right? My interest rate's going to go down, and it hasn't. So what the hell's going on?
Well, hold on. I'll even color that. We've seen that actually occur to a little bit of a degree. The confusing part is that it's not exacting science. Like, I think 2-3 weeks ago, as the time of this recording, I'm not sure when you're actually seeing this, but the market did take a big poop and the rates went down. We were like low sixes for the first time in years, and everybody was throwing a little party.
For like 3 days.
And then like something else happened, and it wasn't good news for the economy, but the rates went up. And I think that's what's got a lot of people, myself included, confused about this relationship.
And it is confusing because it's not necessarily a relationship in that one drives the other. It's that these are the tendencies or the correlations. In other words, they're not cause and effect, they're correlated. So usually we'll see the two same things, but they're not necessarily driven by each other. One thing that's important to understand about the market is that the 10-year treasury tends to drive interest rates, or we see that paired. Most people are in treasury if they're afraid of the stock market. And that's why you tend to see these things kind of play with each other. Right now, there's confusion everywhere. We don't know. Is the dollar going to tank? Are we looking at gold sinking? Like, are there a number of different things that are being paid attention to in the normal investment arena?
So is it that people are sitting to cash? Because normally they're either in the stock market or they're like, oh, that's not good. And then they go to the long-term bonds to kind of be a safe haven. But if that's not true, is it just they're like, they're nowhere?
I have to imagine there's some of that for sure. But the confusion in the trading in agreement with what we're seeing is why there's a pause and why we're seeing this disconnect from the normal, I'd say, trends or relationships between these things. And so it's making it even, as if it weren't hard enough to predict interest rates right now, it's making it even harder to kind of see the writing on the wall. So I think a lot of people are now taking the, I guess, the stance that, well, this is probably where we are for a little bit, right? We've got a weird market. We've got a weird bond yield. And now we're starting to see things just kind of settle in where people are like, okay, I guess rates are in the 6s and 7s now, and that's just where we are. So we're starting to see buyers come back to the table. They're no longer waiting. Starting to see sellers say, hey, there's a little writing on the wall. Maybe I need to get out of this. So I know you're going to talk a little bit about that, but from a rate perspective, very interesting time.
You're making a really good point right now, because going back to the 2 weeks ago or whatever, where the rates were low for 3 days, we saw all of the strategery camp show up with the quickness, like, oh, the buyer who started the process a year and a half ago or 2 years and was like plotting the market. And that's the challenge with real estate, gang. You've heard us say it here before. I'll say it again. You can't time the market. It's only time in market. So yeah, of course we want the lowest rate. Yeah, we want the lowest price if we're trying to get in. But the challenge that creates, though, is that when it does happen, it's usually too late to respond too quickly to do anything about it. So if the rate, craziness and chaos is now the new norm, well, then it's like, okay, then that's not really a place that can deserve my focus and attention. So then we move maybe over to see if the real estate market is the place to be able to deserve our attention. Inventory right now, gang, is surging. So inventory surge, Jer, this, usually creates a window of opportunity, right?
Definitely.
So for example, Detached homes, inventory jumped up almost 32%.
Yeah.
On attached homes, even more dramatic, it's almost 61%.
Yeah.
Okay. Months of supply of inventory up almost 30% on detached, up almost 60% on attached.
Wow.
So what does that all mean? Well, normally, when a market creates amount of opportunity like that, it starts to drive competition. So we're officially in a moment right now where competition is back.
Yep.
Right? So you've always had that kind of, it's like, it's a seller's market, it's not a buyer's market. Oh, it's a buyer's market, not a seller's market. We're in this kind of, this wobble, if you will, a little bit, where it's starting to happen. And the only thing that's holding on are the prices, but they're not holding on to the tune or the degree that we've seen in the past.
Right.
So it might be that the first domino of prices has already maybe dropped previously, and we're starting to see it now in the slowing of this, because we're only up, detached is only up 3%.
Yeah.
And Zillow, by the way, if you keep track to all these, they just actually adjusted all their 25 forecast over the weekend. I love how they put bad news over the weekend on Easter.
Right.
Like no one's going to find it, right? Zillow, great.
That's because the Mudgeon is working on the weekend.
That's fair too.
Yeah.
So they just adjusted, and they basically said what we said last month, because we had just gotten in from that Altos research. And if you subscribe to our channel, ding, you would have gotten that. That now 25, as long as the rates stay put or, God forbid, go worse, they expect that the appreciation is actually going to go negative for the first time in 25, first time in a long time. First time actually since Obama's first term. In 2008, I think it was, when we moved into the Great Recession or whatever. Does that sound right? Obama's first term, I think that was 2008, 2009. First time. So what does that mean? That means despite all the craziness this has gone on, including COVID and you name it, we've still eked out gains no matter what.
Right.
Even last year, even the year before, when rates got up 8.25, we still eked out gains. So basically they're saying is the gig might finally be up. And the driver is what Jer led off with, which is that we have to pay attention to the rate. So does that mean that you put your entire real estate search on hold and you just to your curmudgeon comment at 3 a.m, incessantly obsess over the rates? Well, you could do that. It's probably not going to do much for your mental health, right? So in the meantime, you say to yourself, okay, is this the moment where I just make a decision that I'm going to be a buyer no matter what? And I do my best to try to time the market and the rates. But really, this is my moment as inventory is spiking and rates aren't going down yet. Okay. The big emphasis on the yet. Because if the economy continues to crumble like it is, chances are rates are probably going to maybe come down a little bit more. Would you agree with that?
Absolutely.
Right. And when the rates come down, what happens to prices?
Yeah, go up,
right.
typically.
So this could be that little window gang and coinciding perfectly, perhaps, with the late spring, early summer market, when you see all of the inventory spike anyway, organically, when the other demand hasn't quite met the supply yet.
And I want to say this out loud because I think this is an important part of what you just said. If you're waiting for prices to go down, you're also waiting for the Black Friday sale to happen.
Right.
And you're inviting yourself to be in line with a bunch of angry, aggressive shoppers.
Yep.
And you're going to be having a conversation where it's not like, should I pay that or not? It's like, oh my God, pick me. And that's a very different energy. It's a very different strategy. And you might get a home for a little bit cheaper, but if you're in the trenches in a negotiation, in a price war, it's tough. And what you'll find is you give up some of the intangibles, right, Jess? We see this all the time. Like maybe someone gets what they want in price, but then they didn't get the repair that they were hoping for, or they didn't get that particular home that they'd hoped for. They had to get the other one because there was too much competition. Like I could just go on and on and on about what competition means relative to price.
Sales are slowing. Now remember, this is last year. We had the lowest sale count since 1995. Which is remarkable because you think of how many more people have moved to San Diego since 1995. You think of how many more homes have been built in terms of supply since 1995. And we had about the same amount of transactions in 2024 as we did nearly 30 years previous. And sales right now are already down from even last year's standards in 25. So you're like, well, what do I do about that? Well, here's where the rubber again might meet that road. So again, detached down 7%, attached down 10.8% overall sales, but pending sales up 1.5 to 2.6% respectively.
Sure.
So now it's like, okay, well, what does that mean? Well, to Jeremy's point and to the overall thing of timing, this could be one of those situations where the invisible buyer pool is doing exactly what Jeremy is saying, which is like, you know what, man, I can't wait anymore. because the kids already came. We're already out of space. We're done with storage. I got the job over here, and I hate commuting. All the reasons why people moved, regardless of the market anyway, and haven't yet, is they're finally basically throwing in the flag and saying, you know what, I can't time this anymore. I'm just going to get in. And that's the very interesting little rub on that, because if sales start to pick up, then it becomes a situation where you say, okay, how much inventory actually is there to go around? And if the inventory is spiking, but it's still down to historic level lows, you might be in a situation where in trying to time it, because remember, at the end of the day, it's still an N of one, right? You might think of all these data sets as an aggregate, but the bottom line is there's one home that you want on one street in one neighborhood.
Yeah.
And it's only going to come up one time in your entire buyer search. So if you're not ready, pre-approval, docs in place, lender ready to rock, out there with an agent, already looking at homes, maybe throwing in an offer or two, maybe throwing it a little lower because it wasn't the one that was perfect or whatever. Those are the ones that are going to win when that perfect home does show up on that perfect street on the perfect block.
Yeah.
And it probably isn't going to happen again until you wait till 2026.
Yeah.
And then all bets are off on what 26 is even going to look like. Because if the rates go down between now and then, prices are going to go. Now you're going to be kicking yourself that you didn't take advantage. Even though the market ain't perfect, it's a little weird right now, 25 might be the moment.
Yeah, and I'm reminded as you're talking about that, stats can be funny. Numbers can be funny. So when you start talking about 30%, 60%, you're like, man, that's a lot of what, right? If there were 10 homes on the market and it went up 60%, there's 16 homes. That ain't a lot.
Right.
Right. So we have to remember what these percentages represent. They're relative from a very low base.
Yeah.
And that's something to be careful of too. Yeah. Hey, can we talk about people who aren't buying or selling for a second?
You're going to make a good point, though, because if I think this is where you're going with it, if normally people are moving at a normal increment, I think, right, and they're not, then what it means is that they have to basically improve the space that they already got.
Right.
Is that what you're saying?
Yeah.
Okay.
And what are they doing? Right. So people have bought homes. You might be one of them. You bought a $500,000 home, $600,000 home. It's worth $1 million all of a sudden. You're like, I'm rich, but it's in there
on paper,
and I'm stuck with my 3 or 4% interest rate.
Good for you, by the way. Good problem to have.
Yeah, sure. You're welcome.
Yep.
And then the problem becomes, hey, I want to build an ADU because grandma needs to come live with us, and we can't afford to go buy a 2-unit complex because of all the things or whatever the conversation is.
Right.
How do we get money? A lot of people utilize a few different components. Typically, it's HELOCs or HELoans and maybe some equity share programs. You have to be really careful with this. And I'm not going to go into the details about it. I do this planning with people all the time. But the bottom line is watch out. Look at the terms. Know if they're adjustable or not. Have an exit plan. Make sure that you've qualified a lot of different components, including adjustable rate mortgages. So many different aspects to look at to defend yourself against potential obstacles. And I've been doing this long enough. We've been doing this long enough where we've seen this cycle before.
Yep.
Good rates. Don't want to touch it. Get a second. Can't pay it off. Now I'm stuck. Really, really vicious cycle if you're not planning in advance. It's a good time to utilize a HELOC. You can do that sort of thing very effectively, very cheaply right now. There's a reason they're giving them away for free.
Yeah, because they're indemnified, because a lot of folks have doubled the value of their homes over the last 5 years,
Tons of
6
room.
years.
Yeah. If a bank is giving you a financial product for free and paying all the closing costs and doing everything, you may want to just pause for a moment and ask why they might be doing that.
Yeah, and there's nothing wrong with that, right? But to your point, you got to have a plan. We saw this literally explode while it imploded at the same time, like nuclear reactor style in 2009, 10-ish, before it kind of went back on its feet again. And you got to remember too, like, so everybody, and myself included, we're all guilty of this. We always believe our homes are going to be worth more tomorrow than they are today.
Yep.
Right? And we always believe we're going to make more money on our job tomorrow than we are today. God bless you if that's all true. But sometimes real estate and the markets don't actually behave that way, and it can extend out the time frame. But if that loan starts becoming due and they want all that money back plus an accelerated payback, all of a sudden you're in a situation where you can't afford it.
Yeah. Do you know that on these HELOCs, they can actually close the line and say you can't draw on it anymore? So a lot of people will get a $200,000 HELOC. They only need $100,000. The rest is a safety pad. This is a really common utility of it. Guess what? In troubled times, the banks can close the line and say, you still owe us $100,000, but you can't borrow any more on it. It's not a safety pad in that way.
Nope.
Be very careful about the terms.
That's right.
Yeah. So the conversations I'm having with clients right now, and I'll share this here, is have the plan that you're going to be able to get out of this new loan with strategy and in some way come out the other side without the magic pill being, I'm going to sell my house for a lot more than I bought it for, or I'm going to make more money, or anything like that. You can't count on exterior factors. You have to have a plan in place to put that together.
Yeah, well done. And gang, that's what we help put consciousness to. We take the craziness and chaos of all that stuff going out there and then take your individual pecuniary profile, marry the two up, and come out with some best options, right? And so our little trope, if you will, is whenever you're ready, ... And so thanks for checking in. Go ahead and hit the subscribe or share this to somebody who you think might have also appreciated some of this content. And we'll see you back here next month.